Hello and welcome to this chapter overview video about chapter 5, which is merchandising operations. So our learning objectives for this chapter, you should be able to describe merchandising operations and the two types of merchandise inventory systems. We're going to be able to account for the purchase and sales of merchandise using a perpetual inventory system. Adjust and close the accounts of a merchandising business, prepare a merchandiser's financial statements, and finally use the gross profit percentage to evaluate business performance. So let's take a look at our first learning objective, merchandising operations and inventory systems. We're going to look at sales revenue, differences on the financials, and periodic versus perpetual. So the operating cycle of a merchandising company, or all companies really, begins with cash, but then a merchandising company takes their cash and they buy inventory, and then inventory is an asset whose purpose is to sell to customers, right? So then they sell the inventory and they get an accounts receivable. They collect the cash from their customers and they get more cash, and then they keep going round and round with this operating cycle. They take the cash and buy more inventory. So inventory refers to, or merchandise inventory, refers to unsold items that are held for sale to customers. And it is an asset. It's reported as a current asset on the balance sheet. Once inventory is sold, it becomes an expense. So once the inventory is sold, it is reported as cost of goods sold, and that's the cost of the inventory that was sold during the period. Remember that cost of goods sold is an expense even though it doesn't have the word expense in it. So sometimes students forget about that because it doesn't say expense. So cost of goods sold is an expense. If you imagine that you go into a store and you buy a sweater for $100, say that sweater costs the store $30. Well, the store has a sale for $100, but they also have cost of goods sold of $30. Now, our income statements for a merchandising company versus a service company are a little bit different. So instead of service revenue, now we have net sales revenue, and we'll see how we calculate that. We have our expense, cost of goods sold, and then we have gross profit, which is equal to our sales revenue minus our cost of goods sold. And gross profit is the amount of money that the company has to pay all of the rest of its expenses and then generate a profit. So it's really the same as the other income statement. It's revenues minus expenses, except we have this one little subtotal in here. The balance sheet of a merchandising company is also very similar to the balance sheet of a service company, with the addition of merchandise inventory and our current assets. Remember, merchandise inventory is the inventory that's on hand, ready to sell to customers. There are two types of inventory systems, the periodic and the perpetual. So periodic, which is covered in your appendix, we're not going to study it in this class, but you should be familiar with how it works. And with the periodic inventory, the company does not adjust its inventory account when it buys and sells inventory. It records purchases in a purchases account, and then at the end of the accounting period, they count up their inventory, and then they update their inventory records. Because most companies are using computers, of course, to keep track of their inventory, most companies use what is some form of a perpetual inventory. Perpetual, of course, if something is perpetual, that means it keeps happening on, right? And perpetual inventory means that the inventory account or the merchandise inventory account is always up to date. So when you look at the account, it's going to tell you how much inventory you have. So when inventory is purchased, the inventory account is increased, and then it's decreased whenever inventory is sold. All right, so the next thing we're going to look at is recording purchase transactions in a perpetual inventory system. We're going to look at purchases, returns, allowances, discounts, and freight, and then put those together and we get the net cost of our inventory. So let's say Chic Shoes purchased inventory costing $5,300 on account. All right, so they're buying an asset, right? So hopefully you're thinking in your head, okay, assets have a debit balance. Our asset is going up, so we're going to debit the asset. So we're going to debit merchandise inventory for $5,300. It's on account, meaning that we haven't paid for it yet. So our credit is going to be accounts payable. Remember, accounts payable is a liability with the credit balance. It's going up. Remember, I told you that if you do well in your first few chapters and you understand your debits and credits, it's going to be relatively easy from here on out. So hopefully this makes sense to you, okay? It does get a little trickier as we go on. All right, so let's say now that Chic Shoes finds out that some of the inventory that it bought was defective and it returns the inventory. When a buyer returns the inventory, all they have to do is reverse this entry. So we're going to debit accounts payable because we don't owe the money anymore. So our accounts payable is going to go down. And we're going to credit merchandise inventory because we don't have the inventory anymore. So our inventory is going down. Okay, so we call this account returns. We call this the returns and allowances. In this case, we returned the inventory. But it could be that there was an allowance instead. So it could be that we bought the inventory and we said, listen, these are blue shoes and we ordered black shoes. And the company says, okay, listen, we'll give you a credit for it. Just keep the shoes, right? So in that case, you would record it exactly the same here because you would be reducing the cost of your inventory and reducing the amount that you owe your supplier or your vendor. Now, purchase discounts occur when a company allows another company to pay less if it pays its bill faster. Now, that makes sense, right? The company says to the other company, hey, if you pay me early, I'm going to give you a discount. So that's good for everybody because the seller gets the money faster and the buyer pays less, right? So an example of credit terms would be 210 net 30, or could it just be 210 N 30, which would mean net 30. What does that mean? It means that the company, the buyer, gets a 2% discount if it pays its bill within 10 days. 2% discount if it pays within 10 days. If it doesn't pay within 10 days, then it has to pay the entire balance in 30 days. So 210 net 30. If you don't take the discount, you have to pay the whole bill in 30 days. It always pays to take a discount if you are offered it because you're getting 2% for paying only 20 days earlier, which is a very big interest rate. All right, so how much will Chic Shoes pay if they pay within the 10 days? Well, remember, they bought inventory for $5,300. Then they returned $300. So they now owe their vendor $5,000. Now, if they pay within the discount period, they get a 2% discount. Now, always be careful when you're doing exercises with this. Make sure that you take out the return first and figure out how much they actually owe the company before you take your 2% discount. So they owe the company $5,000. We're going to take 2% of the $5,000, which is $100. So they actually have to pay the company $4,900. All right, let's talk about freight or transportation costs for a minute. So freight in is when the company pays freight on merchandise that it's buying, and that's part of the cost of inventory. So imagine you buy something online, right? And you have to pay shipping. Well, how much did the thing really cost you? It cost you the price that you paid, plus it also cost you the shipping. So shipping for something you buy is an additional cost of the inventory. Shipping on something you sell is an expense. It's just an expense of operations, of delivering the goods to your customers. Now let's take a look at FOB shipping versus FOB destination in a minute. First, let's look at how we record freight in and freight in for a purchase. So let's say that Chic Shoes pays $150 for shipping the shoes. So they ship shoes to a customer. They did not ship shoes to a customer. Go back. Chic Shoes paid $150 for the shoes that they bought, right? Okay, so Remember, that's an additional cost of the inventory. So they're debiting inventory $150 and they're going to credit cash $150 because that's an additional cost of the inventory. Now, there are two terms that you can have for shipping. You can have FOB shipping or you can have FOB destination. And I am going to put up a separate video for this to explain it in a little more detail if you're confused. But the seller sells the goods, right? Puts them in the truck, shipping them to the buyer, right? Let's say the seller's Amazon. You bought something from Amazon. They put the stuff on the truck. Here are your goods. Here's you. They ship the goods to the buyer. All right. Eventually, the goods are received by the buyer. All right, so FOB shipping says ownership passes to the buyer when the goods are shipped. As soon as the goods are shipped, ownership passes. So that means the buyer has to pay the freight because the buyer owns these goods that are on the truck, because as soon as they got shipped, ownership passed to the buyer. FOB destination says ownership doesn't pass to the buyer until the goods are received. So that means these goods that are on the truck still belong to the seller all the way till they get here to the buyer. All right, so the seller is paying the shipping. So FOB shipping versus FOB destination has two important things. One is it generally determines who pays the shipping costs, and also it helps determine who owns these goods that are in transit. So if it's the end of the year and these goods are between buyer and seller, you use this to determine who they belong to. All right, so now let's take a look at the net cost of this inventory that Chic Shoes bought. So remember, we looked at all this. They bought some, they returned some, they got the discount. That got us to the $4,900. Now we have to add in the freight cost, which was an additional cost. So that gives us a net cost of the inventory of $5,050. Important to know the cost of your inventory because that's going to help you to determine how much you sell it for, right? And you want to be making a profit. All right, so now let's take a look at recording sales in a perpetual system as promised. We're going to look at cash and credit sales, returns, allowances, discounts, and freight again, and net revenue. This probably sounds familiar because it's the mirror image, right? It's the same thing we looked at from the other party's perspective, from the seller's perspective. So now let's say that Chic Shoes sells some inventory on account for $450, terms 210 net 30. The inventory cost Chic Shoes $300. All right, you're going to notice there are two journal entries here for one transaction. This is something that often gives students trouble because it's a little bit confusing. All right, so let's think about this. The company earned revenue on account. All right, so think in your head, company earned revenue on account. How do you do that? So before we would say accounts receivable, service revenue. So now we're going to say accounts receivable is debited and sales revenue is credited. Okay, same as before for the selling price of the goods. So we're debiting accounts receivable, crediting sales revenue. By the way, if this were for cash, it would be the same thing, but instead of accounts receivable, it would be cash, right? You would be getting the cash. Now, at the same time, this inventory is going out and we have to record our cost of goods sold. So we make a second journal entry where we debit cost of goods sold, because remember what cost of goods sold is exactly what it sounds like. It's the cost of the merchandise that we sold to our customers. And we credit merchandise inventory for the cost that the inventory, for the cost of the inventory to us, right? So this is the revenue entry, and this is taking the merchandise inventory out of our accounts and recording the cost of goods sold. Sometimes I tell students to remember all students can invest. If you want to remember the inventory, all students can invest will help you to remember these two journal entries, one at selling price, one at cost. How much money did they make on this? We're going to talk about gross profit again. Selling price minus cost of goods sold, they made $150. All right, let's say now that a customer returned some shoes that they bought. The customer bought them for $45, but the shoes cost Chic Shoes $30. So basically what we have to do is reverse everything we just did. We recorded a sale and now we have to reverse it, okay? Now, you might be thinking to yourself, okay, well, we're just going to take all these and reverse them, right? Do backwards, which is almost right. It's almost right with one exception. We are going to debit an account called Sales, Returns, and Allowances. Now, why don't we just debit sales? The reason we don't just debit sales is because the company wants to keep track of how much its customers returned. And by having a separate account, that's really a reduction of sales. We're going to use this to reduce our sales, but we have a separate account so we know how much our customers return. And the rest is a reversal of what we did before. We're going to credit accounts receivable because our customers are not paying us that money anymore. This is our selling price. We're going to debit merchandise inventory because it came back, so we have our inventory again. And we're going to credit cost of goods sold because we didn't sell it. So basically what we did was we took this entry from before, we reversed it with the exception of the sales returns and allowances. Okay? Next up, let's look at what happens when we have an allowance. So a customer found some damage on shoes they bought for $60. The store agrees to an allowance of $20 and the shoes cost Chic $40. All right, since the inventory was not returned, there's no second entry. We don't have to put the inventory back in and reduce the cost of goods sold because we're not getting the inventory back. So we're just going to debit sales returns and allowances for $20 because we gave them a reduction in price of $20. And we're going to credit accounts receivable because the customer is not going to pay us that $20. Okay? So a sales return and a sales allowance are very similar, except the sales return you have to put the inventory back in and the sales allowance you don't. All right, so recording collections with a discount. Now, let's say the customers who bought shoes for $100 with terms 210 net 30 send in payment within the discount period. Okay, so the customer owes us $100. They get a 2% discount on the $100 that they owed us. So 2% of 100 is 2, and they're going to pay us $98. So we are receiving cash. We're debiting cash for $98. Our cash is going up. We're going to debit sales discounts, which is also a reduction of our sales. We are going to credit accounts receivable. Okay? Now, so I'll put these percentages in here to remind you that you debit cash for however much your customer is paying you, of course, and your sales discount is going to be the 2%. Make sure that you credit your accounts receivable for 100%. Because even though the customer is not paying you the $100, they are discharging their liability that they owed you, right, for $100. So you're not going to get the 100, you're going to get the 98. But you're happy because you got it early, right? All right, so now let's say that Chic Shoes ships, this is like a tongue twister, Chic Shoes shipped shoes to a customer paying cash of $20. All right, so a customer said, hey, I want those shoes, but I can't get to the store. Can you please ship them to us? And they said, okay, fine, we'll ship you the shoes. We are going to debit delivery expense and credit cash for $20. Remember, this is just an operating expense. All right, let's take a look at inventory shrinkage, our adjusted trial balance, and our closing entries for a merchandising company. Inventory shrinkage this is what happens. Let's say the inventory records say you're supposed to have X number of dollars of inventory on hand, and then you do what we call a physical inventory. Maybe some of you have done that in stores that you've worked in. You go around and they count all the inventory and they add it all up. And then sometimes there's a difference because, of course, it's never going to be perfect. It could be people made mistakes. It could be inventory was stolen. It could be inventory was damaged and people forgot to record it. So let's say that Chic Shoes counts its inventory and it finds out that they have $250 less than what the records are showing. So they have $250 of shrinkage. So now they have to reduce their inventory. and they're going to debit cost of goods sold. Because we don't really know what happens to that inventory. If it was a very, very large amount, you might record a separate loss. But for our purposes for now, we're just going to say we'll debit cost of goods sold. We're going to credit our merchandise inventory to bring it down to the amount that's actually on hand. Now our adjusted trial balance is going to look just like our old adjusted trial balance, no different, except that you're going to have some new accounts, right? It's still in the same order: assets, liabilities, equity, revenue, expense. Here are our new accounts that we didn't have before. Merchandise inventory, that's your inventory on hand, which is a current asset. Sales revenue is a revenue account, has a credit balance, right? Sales returns and allowances and sales discounts are contra revenue accounts. They have debit balances because remember, they're a reduction of your sales. Cost of goods sold is an expense. Of course, that has a debit balance, and delivery expense is an operating expense, and that also has a debit balance. Now, when you're closing your books for a merchandising company, it's the same as that for a service company. The only difference is you have these new accounts, these temporary accounts that have to be closed. Now, remember, we had our list of new accounts here. Merchandise inventory doesn't get closed because that's an asset. The rest of these accounts are temporary accounts, so those are going to get closed. So remember, sales revenue has a credit balance, so we debit it to close it. Sales returns and allowances, sales discounts, cost of goods sold, and delivery expense, those all have debit balances, so we will credit those accounts to close them. All right, now let's take a look at the merchandiser's income statement. We're going to look at net sales revenue, multi-step versus single step, and gross profit. So net sales revenue is basically your sales revenue minus your two contra revenue accounts. So we take our sales revenue, these are the numbers from Chic Shoes. We take our sales revenue, 450, minus the sales returns and allowances of 105. That was the 60 plus the 45. I don't know if that's right, but we'll just keep these numbers the way they are for now. So let's say our sales returns and allowances were 105. We know our sales discount was 2. Take the 450 minus the 105 minus the 2, and you get 343. That's your net sales revenue. Remember, we saw that on our income statement. All right, so here it is here. Here is our net sales revenue, which is just like we calculated here, but this is for the company that's in your book, Smart Touch Learning. So the net sales revenue, this is the same thing we saw at the very beginning of this video, except it has some more detail in it. Sales revenue minus cost of goods sold gives you gross profit. We have all of our operating expenses. In this case, they're broken up into selling expenses and administrative expenses. Selling expenses have to do with actually selling the merchandise, like advertising, sales salaries. And administrative expenses have to do with running the business as a whole. So for example, insurance expense, maybe salaries of managers and things like that. Add up all your operating expenses, subtract them from your gross profit, and you get total operating expenses. Subtract those from your gross profit and you get operating income. Here we also have interest expense, which is an other expense. You might also have interest revenue. Other income and expenses are things that a company incurs or revenue that they get that does not have to do with their main business. So this company sells goods for a business, for its business. So interest expense is unrelated to its regular business. It's another expense. So to take that minus your interest expense, that gives us income before income tax expense. A lot of companies show the income tax expense as a separate number because it's a relatively important number. And then you have your net income. Remember, you're still doing revenues minus expenses. Revenue minus expenses, minus expenses, minus expenses, minus expenses, right? But you have some subtotals in between. Now, a single step income statement doesn't have all of those subtotals. It just takes all of your revenue minus all of your expenses, and it gives you net income, very much like you did for your service companies. Finally, let's take a look at gross profit percentage. It's a very important number that companies look at because the gross profit is a measure, remember, of profitability. So remember, gross profit is equal to net sales revenue minus cost of goods sold, and your gross profit percentage is equal to your gross profit divided by your net sales revenue. Now, it's hard to say what's a good number for this because different industries have very different gross profit numbers. So generally speaking, as with all ratios, you would want to compare this either to prior years or to competitors or to industry averages to make them meaningful. All right, so that's all I have for Chapter 5. Please watch the other videos that you can find in Brightspace and in YouTube having to do with this chapter, and I will see you next time.